I think that this rate cut and the fact that we're getting two more at a minimum between now and the end of the year, that I think ensures smooth sailing for new record highs. I still think we have a good shot at hitting $4,000 gold by the end of the year and $50 silver.
Generally speaking, lower rates should be good for gold because gold doesn't pay interest, right? Though there is an alternative for that right now. But anyway, there's an app for that. So if the signal we got today is that the Fed is going to err on the side of protecting the labor market and cutting rates, that's actually bullish for gold. Never mind what the algos did today. That on itself historically has been bullish for gold.
Record high stocks and rate cuts are fueling bubbles, while gold and silver stand ready to surge. Peter Schiff, a well-known economic commentator and precious metals advocate, recently highlighted the risks of the Federal Reserve's current policy. He argued that the Fed is repeating historic mistakes by cutting interest rates even as the stock market hits record highs, warning that this approach will inflate new asset bubbles just as past policies contributed to the housing crash and financial crisis. Schiff noted that gold briefly touched $3,700, while silver approached $43 before pulling back, emphasizing that both metals remain in a bullish trend. He projected that gold could reach $4,000 and silver $50 by year-end, with silver potentially offering even greater upside thereafter. On interest rates, Schiff observed that long-term yields have started rising despite Fed cuts, signaling that inflation is far from contained. He predicts that inflation will accelerate, forcing the Fed to explain it with new terminology rather than admit policy failure. While the Dow Jones surged past 46,000, other indexes showed mixed results. Schiff warned that the current rate-cutting cycle could be remembered as one of the Fed's biggest errors, particularly as inflation pressures continue to mount. For investors, Schiff advised focusing on inflation hedges and avoiding U.S. dollar-denominated assets. He recommended turning to foreign markets, commodities, energy, and emerging markets, expecting them to outperform as capital gradually flows away from U.S. holdings. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue delivering sharp insights and expert perspectives on the forces driving gold, silver, and the broader financial landscape. Thanks for watching.
Powell was asked about, is he concerned that you're cutting interest rates when the stock market is at an all-time record high? In fact, it made an all-time record high today, and we're just starting a new round of rate cuts. Aren't you worried about asset bubbles? I mean, did you not learn anything from the mistakes of the past? And apparently not. I mean, I already know the Fed never learns from its mistakes. All it does is repeat them on a bigger scale and then act surprised when the same thing happens again, only worse. Anyway, let me talk a little bit about the market reaction to the Fed. We did get a new record high in the price of gold today, just barely. I think we touched 3,700, but it was a roller coaster ride. Silver was down almost $2. There was a big sell-off. Silver almost got to 43 yesterday. And before the open, there was I think they really rushed a lot of the stops, and they had a big drop in silver, almost $2. And a gold was down like $30, $40. But then it was up like $30 after the news came out. So it went on a roller coaster ride, but it only closed down about, $20, $30. So gold's around $36.60. I mean, not too far below the record high. There were quite a few gold stocks, that closed positive on the day. They were down quite a bit yesterday, even though there was just a small move down. But, I think that this rate cut and the fact that we're getting two more at a minimum between now and the end of the year, that I think ensures smooth sailing for new record highs. I still think we have a good shot at hitting $4,000 gold by the end of the year and $50 silver. So right now you still got quite a bit of upside in both, especially silver is now back below 42. So you got about a 20% gain between here and $50. That's not bad. Now, of course, I don't think silver is going to stop at $50. I think it's going much higher, but it may not get much higher this year. So I think by the end of the year, that's a realistic target for silver. So I would buy it now, shiftgold.com, right? We don't just sell gold. We sell gold and silver. But the mining stock charts look even better to me. You know, the GDXJ hit a new, I think, record high. It finally took out its high from 2011. But the GDX, which has been acting stronger of late, still needs to rise about 60% from here, I think, to get back to its 2011 high. But based on the chart, it looks like it's going to go there very quickly. So I would be buying these stocks as quickly as I can. You know, my favorite way to participate is my own gold fund, the Euro Pacific Gold Fund. EPGIX is the no load symbol. You could pick that up anywhere. And I'm not just saying you should buy gold stocks or my fund because I make some money. Of course, I don't make any money if you just buy gold stocks at some random discount broker. But I'm happy regardless. But I think our fund has a lot to offer, and I think we're going to outperform over the long term. But the real reason I want my audience to buy them is because I think you're going to make a lot of money if you do. It's not that there's no downside risk. There is, but I think it's minimal when you compare it to the upside potential, which I think is enormous. And unlike the Fed, I have a lot of confidence in my forecast. I'm very sure that I'm right. I don't guarantee that I'm right, but I think I am. The Fed has no clue, right? But my forecast is not just a guess. Right? It's based on my understanding of monetary and fiscal policy that apparently is lacking at the Fed. But we did have a bit of an up move in interest rates on the long end. The 30-year closed a little higher on the day, and that's been my forecast. The 10-year is 4.09. A couple of days ago, it was down to like 402, 403. I think we're headed higher from here. Right? I don't think the long end of the bond market is going to react positively to the Fed cutting interest rates when inflation is not only well above 2%, but headed in the opposite direction. The stock market, again, hit record highs. I think the Dow Jones hit a record high today, and it closed in record territory above 46,000. Dow was up 260 points today. The NASDAQ was actually a little bit lower on the day, as was the S&P. Neither hit record highs. It was just the Dow. Russell 2000, not a record high, but also up on the day. But overall, the stock market likes the news that the Fed is cutting interest rates. But I can assure everybody that this is a major policy mistake. This is going to go down, I think, maybe as the biggest mistake. And that's saying a lot because they've made so many big mistakes, like the ones that led to the 2008 financial crisis, inflating that housing bubble, and the mistakes over COVID that led to the transient inflation that wasn't transient. So they've made a lot of mistakes cutting rates, and this could be the worst one because inflation is headed much, much higher, and they've already put themselves on a preset course to cut rates, and they're not going to change from this course because they know what it might mean to the market. So they're going to have to rationalize all the upticks in inflation and attribute it to the one-off effects of tariffs. They probably don't want to say transitory, so I guess they'll come up with another word that means transitory, like with abundant and ample. Maybe not transitory, what transient or temporary. I don't know, whatever. They'll come up with a synonym that means the same thing, but doesn't quite subject them to the same degree of ridicule. But you got to look through all that. And you got to load up on inflation hedges. All your investments, I think, should be non-U.S. dollar. The dollar's got a one-way ticket down. You don't want to go down with that ship. You want to abandon ship, and you want to buy foreign stocks that continue to eat the lunch of the U.S. stock market year to date, despite the fact that it's hitting nominal record highs. So you want to, all the Euro Pacific funds, I think, are great. The dividend payer fund, the value fund. The emerging markets, I think, are going to be the stars of 2026. Just my value and dividend payer funds are doing better this year, but I expect a major move up in emerging markets next year and the year after that and the year after that, because I think that the transition is out of U.S. markets into international markets, and then it's going to be from developed to emerging markets, but all of it non-dollar and commodity focused. Energy, I think the energy prices are still low, so energy stocks are still very cheap. Maybe not as cheap as the miners, but they're still cheap. We still have good allocations there.
Lobo Tiggre highlighted that during the last period of stagflation, marked by high inflation and weak labor markets, oil and gold were the standout performers. Today, with OPEC increasing production rather than cutting supply, gold emerges as the primary haven. Even at $3,700, Tiggre emphasized that the outlook for gold remains strong, particularly as stagflationary pressures build. He cautioned that short-term market movements, often driven by algorithmic trading rather than human decisions, can be misleading, and investors should focus on longer-term trends. Tiggre also pointed out that central bank gold buying has been a game-changer, establishing a much higher floor under prices and supporting bullish sentiment even above previous all-time highs. He noted that while corrections are inevitable, the broader macro, fiscal, and monetary environment continues to favor higher gold prices over time. Powell's comments on the Fed's dual mandate, acknowledging labor concerns while leaving the door open for longer-term tariff-driven inflation, further underscore the uncertainty around policy, reinforcing gold's role as a hedge, with prices remaining well-supported at current levels. Let's get back to the interview.
Powell starts talking, and he said a lot, and a lot of it I think was not really that important. A lot of people had questions about the Fed independence, and it's not that that's not important, but I don't think that was going to move the markets today. My take is the moment when I started seeing things reverse and move was when Powell talked about, yes, we're more concerned about the labor side of our dual mandate. And yes, we think tariff inflation from the tariffs is likely to be, he didn't say transitory, but one-off, short-term. But he said then, but we don't know. We don't know for sure. The tariff policy changes are ongoing, and there could be longer-term knock-on effects. So that really opened the door for not transitory inflation. And the Fed has to pay attention to that. At least, half of its dual mandate is the inflation side. So Powell's saying, like, everybody's been so confident of these rate cuts because the labor market's weakening. And if there's an inflation argument, it's transitory again, right? It's just a one-off from the tariffs. And Powell opened the door for it not being one-off, for inflation actually still being a more serious and ongoing problem. I think that's when people said, ooh, wait a minute. And I think that's why we saw the DXY reverse, because, there was a big re-rate of what are the odds here. And there was a bigger argument to be made for less dovish policy than I think a lot of market participants expected going into this. Well, in a way, this could be the Fed's answer to being caught between its two mandates. They see the weakness in the labor market, so they want to try to cut interest rates a bit to try to help out there and not get too carried away. I do think Powell is well aware that if he just says, okay, forget about inflation, it's transitory, all we got to worry about is labor market now, and they cut too much, and inflation really does go much higher and stays higher, then his dreams of being praised as the next Volcker just go out the window. His legacy will be the next Arthur Burns. And I think he really, really doesn't want that. Or, whatever, Trump can fire him or whatever else happens, he doesn't want to be remembered as an Arthur Burns. If he gets fired for being a Paul Volcker, I think he can live with that, right? So he's stuck in this place, but one way to sort of like pussyfoot around it, frankly, is to, cut on the one hand, but also continue cutting the balance sheet, which is a tightening, right? That does have a tightening tendency on policy. If one is to be as charitable as possible with Powell, that balance sheet needs to be cut anyway. Like almost regardless of what else is going on, we blew that thing out to, 3x over the GFC levels because of the COVID-19 problems, the lockdowns and everything. So I think the Fed has, anybody rational in that body is aware that they do need to normalize that balance sheet, that if they don't, and if we monetize all of that, that really is money printing in a big way. So I think they try to talk about it as little as possible. Remember his famous paint drying remark? I think they would really prefer this happened in the background. But the two ways of looking at it is, one is that, ultimately at the end of the day, that balance sheet does need to be cut. And then the other way of looking at it is maybe this is a little bit of a way for the Fed to hedge its bets here. They have to cut, they have to appear to respond to, the big cuts in the labor market. revisions and all that. The Powell dismissed the revisions and saying, oh yeah, we expected that anyway. Everybody knows what happened the last time we had stagflation. The more painful the situation gets, Kai, the more people will remember, well, what happened last time we had high inflation and weak labor markets? What was the stagflation play? And it was oil and gold. And oil is in a different market right now. We don't have OPEC cutting oil supply. We have OPEC ramping up oil supply. So that leaves gold as the most obvious go-to space here. Maybe it doesn't look like it today, but going forward, the louder that stagflation drumbeat gets, the better that is for gold. And that's a scary thing for me to say at $3,700 gold. But that's the way it looks to me. First, looking at the market gyration, that's almost never a good or a clear signal. I mean, it's important, it's relevant, you need to think about it. But the immediate knee-jerk reaction is almost always wrong. And the thing to remember is that those knee-jerk reactions at the beginning, that's not you or me or the average gold bug calling up their stockbroker and saying, hey, sell my gold stocks. I've changed my mind. Or, that's not the mom and pop, bullion buyer running down to the local coin shop and buying or selling a few more ounces. This is traders trading with their algorithmically programmed machines, and they've got triggers. Oh, if this happens, then sell, or if this happens, then buy. And then afterwards you say, well, wait a minute, that happened, but not for the reasons we thought. So reverse course. So it's very dangerous to put too much weight on the initial market reactions here. They're not human reactions. They're algo reactions. And the algos are often, programmed wrong. So that would be the first caveat here. In terms of the gold market going forward, even before we talk about Fed policy and fiscal dominance and all this stuff, remember the central bank gold buying. That really has been a game changer. It has clearly put a much higher floor under gold. It's not done yet. Maybe someday, years down the road, central banks will stop buying gold. Maybe they won't. Maybe they'll continue moving that way for beyond our investment time horizons. But right now, that's really important because it's not like it was the last time around. So that's one thing. And that makes me less nervous about being a gold bull, even above previous all-time highs. The other thing is, don't forget the fiscal dominance. So, generally speaking, lower rates should be good for gold because gold doesn't pay interest, right? Though there is an alternative for that right now. But anyway, there's an app for that. So if the signal we got today is that the Fed is going to err on the side of protecting the labor market and cutting rates, that's actually bullish for gold. And never mind what the algos did today, that on itself historically has been bullish for gold. Now, if the inflation side comes back, and comes back, stronger, and the market decides, oh, well, the Fed said they were going to take care of the labor market, but they're actually more interested in inflation. This is not what's happening now. But if that did happen, ironically, that would be the knee jerk would be negative for gold because gold doesn't pay interest, and higher, rate increases are supposed to be bad for gold. If that happens, I think that would create a fantastic buying opportunity because at the end of the day, inflation is inflation, and anything real, anything that governments can't print, goes up as the printing continues. So never say never. But if I'm going to look at it theoretically or logically, or I'm looking at the charts, or I'm looking at the macro situation, all these roads point towards higher gold going forward. That having been said, and gold bugs get mad at me, or silver bulls or uranium bulls, whenever I talk about, you get a hockey stick chart, it's not unreasonable to expect some measure of correction. And, that's entirely possible, Kai. Anybody who tells you, no, it's impossible, gold has to go to the moon next, they're selling something, I wouldn't trust them.
Amid growing stagflationary pressures, central bank gold buying, and the potential for sustained inflation, gold and silver continue to stand out as essential hedges. Short-term market movements can be volatile and often driven by algorithmic trading rather than underlying fundamentals, making knee-jerk reactions unreliable. However, the broader macroeconomic, fiscal, and monetary environment provides strong structural support for both metals, even above previous all-time highs. While periodic corrections are inevitable, gold and silver remain well-positioned to preserve value and offer significant upside, making them key assets for investors seeking protection against economic uncertainty and the erosion of fiat currencies. How might the ongoing shift toward gold and silver as safe haven and settlement assets impact the future role of the US dollar in global trade? So, stay tuned for clear, data-backed insights into the financial system. Be sure to like and subscribe so you never miss our weekly updates. Thanks for your support, and we hope you enjoy the video.